All right, we need to go ahead and take a look at a little exercise that deals with adjusting entries. Adjusting entries are generally done at the end of each month, and these are things that can be set up to be done automatically in most accounting software. That of course assumes that we don't have any changes along the way. So if we have a lot of changes that are taking place potentially, it's better to do these types of entries manually. Okay, so we have some selected accounts for a company called Ideal Properties, and these are shown below as of January the 31st of 2019, and these are before, very important, before any adjusting entries have been made. So we've got some unadjusted account balances here. Okay, and I'm counting 1, 2, 3, 4, 5, 6 accounts, and I'm seeing 5 scenarios down here. So either we won't use one of these accounts, or that sounds like probably going to happen. Okay, so as I'm looking down through here, I would say this, very, very important to pay attention. Now, this particular, looks like this is a 2-part exercise, and so one of these is going to be using what we call a financial statement effects template, okay, and this helps us understand, you may have heard me say this before, this financial statement effects template is basically a type of worksheet. When we use, this is not anything official in actual accounting, and these numbers would not go anywhere, but we can see movement between assets, liabilities, impacts to equity that way, or impacts to equity via any revenue or expenses that we recognize during the period. Okay, so let's go ahead and look at number 1 here. It says prepaid insurance represents a 3-year premium paid on January the 1st, 2019. So prepaid insurance is what we call a deferred asset. It is a prepaid asset as well, but it is a deferred asset because we're paying the cash. We paid a 3-year premium of $6,660 on January the 1st. Okay, so we let go of $6,660 on January the 1st, but we are going to have a 3-year premium for that. Now, I want to just say that this is somewhat unusual. Insurance companies don't like to issue 3-year policies for anything. They don't like to go more than about 12 months. However, we have to do what the exercise asks us to do. So the first thing that we want to do before we start entering anything down here related to this transaction is we need to come up with a monthly amount. So let's drag the calculator over here. And it says that we paid $6,660 and that we got that for 3 years. Well, 3 years is 36 months. And so we can calculate pretty easily that our monthly premium is $185. Okay, so we're going to go down here, and what we want to recognize is they want us to enter the relevant figure, in this case $185, wherever it belongs all the way across here. So we're going to take this one at a time. I'll go a little bit slower in the beginning, and then I'll speed up a little bit perhaps as we go. So what happened to the cash asset? Well, with regard to this adjusting entry, nothing. Nothing happened. Non-cash assets. Well, prepaid insurance is an asset and it isn't cash. So what happened? Well, what we have to understand is that our asset was $6,660 as soon as we bought the policy. It is now going to be reduced by 1 month, 185. So this non-cash asset, prepaid insurance, has gone down by $185. Okay, no contra assets here. We have not reduced any liabilities. We've had no impact on capital. And so then we get over here to earned capital. And I notice we don't have a little line here distinguishing. So I'm going to make a little notation here that all of these items right here pertain to balance sheet data, and then everything over here pertains to income statement. So earned capital, well, we reduced an asset by 185, and we didn't increase another asset or reduce a liability. So we have lost $185 in equity. We have no revenues, but this is an expense. We would now expense prepaid insurance or insurance expense for 1 month in the amount of $185. Now notice the expense has gone up, so I do not put this in brackets here. I do not indicate that this is a negative because it's the expense that went up. However, this also has an impact on net income. So expenses have gone up, so that means that net income will go down. All right? With me so far, I hope. The second item says supplies. Let's see, where did I go here? Supplies of $850 were still available on January the 31st. So very, very important to recall that these balances have not been adjusted. So as of January the 1st, we had $1,930 in supplies. We now have $850. So all we have to do is take the $1,930 that we did have and subtract what we still have. And that will give us several pieces of information. So supplies, inventory, just as prepaid insurance is a prepaid asset, a deferred asset, because we pay the cash in advance and then we get the benefit. So we don't have to break this out on a monthly basis. We've already done that. We essentially used $1,080 in supplies during this month. So it's the non-cash asset, supplies, has gone down by $1,080. Okay. And then we have the exact same thing here, just for a different amount. We would also recognize supplies expense at this point. See, there's no actual transaction that we can record as we use these supplies. I mean, we could, but that would get awfully tedious. So we do this as an adjusting entry. And so, you know, I said that the accounting software would allow us to set this up, and it usually does. The prepaid insurance would be a really good one to set up to do automatically because it's going to be $185 a month for 3 months. I'm sorry, not for 3 months, for 36 months, right? So this is an adjusting entry that we would want to set up in our accounting software. However, supplies is not like that. We have to reconcile supplies, see what we have left. And so we figured out that it was $1,080 that we used. I'm sorry, I made a mistake there. Bear with me one moment. I did it correctly in the first one and then I messed it up here. All right, so expense has gone up by $1,080 and net income has gone down by $1,080. Let's look at the third item. It says office equipment purchased on January the 1st, 2019 is expected to last 8 years. What we're saying here, and we'll get into this later in the semester to where we'll find out that the way we're going to do it right here is not exactly right, but we have to take the information that we have. And so we have office equipment. We just purchased it, right? We just purchased it. and we purchased it for $5,952. This is our historical cost. So we're going to plot this here. Actually, I'm going to do something else first. We bought, it's expected to last 8 years. 8 times 12 months in a year is 96. Okay, so our cost is $59.52. We're going to be able to utilize this office equipment for 96 months. Whoops, let's see here. I didn't mean to do that. So $59.52 divided by 96 months gives us an expense of $62 per month. All right, now this is actually, we need to be careful here, because if you haven't read your chapter, this might be a little bit difficult for you. So office equipment purchased on January the 1st. Well, if we paid cash for it, that already happened. Okay, and I don't know if we did or not. I'm assuming that we did. We don't have any non-cash assets that are impacted. And the reason we don't, you said, what about office equipment? That's a non-cash expense. It is, but this $59.52 here has to be left on the balance sheet at exactly $59.52 forever until we get rid of the office equipment. Okay, but more on that much later in the class. So, you know, what we have here is we have a contra asset. And a contra asset is not a regular asset. So we're gonna put this $62 right here. Okay, now we don't have an a non-cash or cash asset that has gone down, but contra assets, they work opposite of a regular asset. So pay attention if you have this question. Pay attention to the instructions. I'm going to enter this as a negative, which for a contra asset or an adjustment account, we have to reverse our thinking. The contra asset went up by $62. So, you know, depending on the instructions, this maybe should be a positive, but technically it should be in brackets, because what it does is it adjusts the $59.52. So if we were visualizing, it would be $59.52 at historical cost, and then a negative $62 as an adjustment to that. And so we have a earned capital here is going to go down by $62. That won't change. And then we're going to have no revenues, and then we're going to have an expense that's going up by $62. It's a non-cash expense. We call it depreciation expense, but it nevertheless counts. And then so we have a negative impact to net income. I want to go back to this just for a moment here. It's $62, and in a way, it's really treated almost the same as this prepaid insurance up here, because the prepaid insurance is actually not a current asset. It's a long-term asset because it's for 3 years. And again, that doesn't normally happen. This isn't a long-term asset for 8 years, so we have to allocate that cost over the useful life of the asset, and that's what we've done here. All right. Number 4 says on January the 1st, 2019, Ideal Properties collected 6 months rent in advance from a tenant renting space for $875 per month. Okay, so this is worded very, this is kind of a trick here. Well, it's not a trick, but it kind of goes against what the way that we've been doing some of these other entries. Okay. So what we've got to make sure of here is, notice that our balance up here in unearned rent is $52.50. And then this was for 6 months. That's how we got the $875. See, what they've been doing is they've been making us do some calculations on whatever figure they give us on these longer term items. We don't have to do that. They just went ahead and gave us the amount of $875 per month. And I just kind of wanted to take that $52.50 and divide by 6 to kind of show you that there was a relationship between this $875 here and the $52.50 that they provide us right here. Okay, so what we have then, we have several things going on with this. Let's see here. So rent, number 4, rent collected in advance on January the 1st. Okay, so we collected it in advance. So we already collected the $52.50. Okay, so there's nothing to put here. We have no impact to non-cash assets nor to contra assets. However, we actually have a liability that has gone down. So unearned rent, and they actually tell us that it's a liability. They don't normally do that. But unearned rent, unearned revenue, that is a liability account. So we're going to go ahead and put brackets around the liability amount because it has gone down. Okay? Nothing here contributed capital. And our earned capital has actually gone up by $875. We didn't impact any assets over here, but we reduced a liability, and that will help us. So our earned capital has gone up. Over on revenues, we also have an increase of $875 because now $875 of this $52.50 is actually earned. When we got it, none of it was earned. Now we have earned $875 because 1 month passed. So revenues go up. We have no expenses on this particular entry. And so net income also goes up. And then finally, let's see here what we have. Accrued salaries not recorded as of January the 31st. Okay, so I'm kind of going about that backwards. Let's see. Number 5, accrued employee salaries of $490 have not been recorded as of January the 31st. Okay. So let's see what we have here. The fact that it says accrued employee salaries means that we did set up a liability for this. Let's see here. Have not been paid as of January the 31st. Okay, so actually what we need to do is we need to accrue this liability. Is what we actually need to do here. So let's go ahead and do it. All right. So we have a liability that is going up. All right. And that means, and we didn't decrease, or we didn't increase an asset at the same time. So we have a $490 hit to our earned capital. Over here on the income statement, we would go ahead and recognize this like a salaries wage expense for $490. Well, if an expense goes up, then net income goes down. Okay, so we don't have to, looks like in this particular exercise, we don't have to total everything. Now, if we did, this would be a very useful tool for understanding impacts on equity. In this case, we kind of have to take it on a transaction by transaction basis. But anyway, that's the financial statement templates, effects template for adjusting entries, and then we'll have another video for the actual journal entries.